A triple net lease can look simple on paper because the base rent appears lower. But in Sarasota, the real question is what the rent becomes after taxes, insurance, and maintenance move over. In commercial real estate terms, a triple net or NNN lease shifts three major expense categories from the landlord to the tenant. Those expenses are property taxes, building insurance, and most maintenance or operating costs, in addition to the base rent the tenant pays. Importantly, those items are not fixed. They can change with insurance markets, tax reassessments, the property condition, and overall performance. That means the advertised base rent is only a partial number when evaluating occupancy cost under an NNN structure. For example, a space quoted at $20 per square foot can produce an effective occupancy cost closer to $26 to $32 once NNN expenses are included. Compare that to a gross lease, where operating costs are bundled into rent, making monthly payments more predictable for the tenant. A modified gross lease sits between those two. Some costs are shared, creating moderate variability compared with a fully gross structure. Triple net leases increase transparency by separating rent from operating costs, but that transparency shifts cost variability onto the tenant. The real NNN risk is not the label itself, but how exposure to costs is written into the lease language and passed through to the tenant. Common pressure points include uncapped operating expense, pass-throughs, insurance premium volatility, and tax reassessments after a sale. Another major exposure is capital expense pass-throughs, where amortization clauses let landlords spread big repairs across tenant charges. Many tenants focus on base rent and underestimate total occupancy cost because the true exposure is often embedded in lease details. Risk also varies by property type. Retail strip centers spread costs across tenants, which can reduce individual burden but increase shared variability. Single-tenant buildings give that tenant more control, but also maximum exposure for big-ticket items like roofs, paving, and structure. Industrial and flex properties often fall in the middle, with operational needs and maintenance profiles that differ from retail and office assets. Location matters too. Coastal and high-traffic Sarasota corridors can have higher insurance and maintenance exposure than inland industrial zones. An NN lease makes sense when a tenant wants long-term control, when operating costs are historically stable and responsibilities are clearly limited. They become problematic when costs are poorly documented, structural responsibilities are vague, or a tenant lacks margin to absorb swings. Investors often like NN properties because shifting expenses to tenants can make net income streams look more predictable to buyers. Single-tenant NN assets leased to credit tenants in Sarasota commonly trade at lower cap rates because buyers view income as less variable. Ultimately, lease structure determines where financial risk sits, which directly affects both effective occupancy cost and property value. Practical takeaway: read the lease lines, not the headline rent. Quantify historical NNN charges, cap, or clarify pass-throughs and plan for variability. If you are a Sarasota tenant or buyer, engage advisors, demand clarity on amortization and caps, and model effective occupancy cost before you sign. A well-structured lease aligns incentives and protects both tenant and investor, so treat NNN as a strategic choice, not a default label. Thanks for watching, and if you are evaluating a Sarasota NN opportunity, start with the lease details and build your budget around effective occupancy cost.